Hello everyone. Welcome back to the channel. Today we're diving into one of the hottest corners of the stock market right now, artificial intelligence cloud infrastructure. Two names that have been impossible to ignore in 2025 are Nebius Group, ticker Nbis, and CoreWeave, ticker CRWV. These two stocks have taken Wall Street by storm. Nebius is up more than 300% this year alone, while CoreWeave has skyrocketed over 230% in just 6 months since going public. Both are benefiting from one of the strongest secular trends of this decade, the need for massive computing power to train and run AI models. The growth story is obvious, but the real question is, if you could only pick one for your portfolio, which company deserves your money? Let's break it down step by step. Nebius has been the surprise underdog in 2025. Not long ago, this was a relatively small player with only $156 million in revenue during the first half of the year. But that number doesn't tell the whole story. Revenue was up 145% year over year, and analysts expect full-year revenue to grow nearly 390% to $576 million. For a company starting from a low base, those growth rates are explosive. But here's the real kicker. Nebius recently landed a 5-year mega contract with Microsoft worth $17.4 billion, with the possibility of expanding to $19.4 billion if Microsoft uses more of their services. For perspective, that's not just a big deal. It's a contract worth more than 30 times Nebius's current annual revenue. This single partnership has the potential to transform Nebius from a small, niche player into a serious heavyweight in AI cloud services. Now, why would Microsoft turn to Nebius? The answer lies in capacity shortages. Right now, the biggest cloud providers, Amazon Web Services, Microsoft Azure, and Google Cloud, are all struggling to keep up with demand for AI workloads. Training large models like GPT-4, Gemini, or Claude requires enormous clusters of GPUs, and the existing infrastructure simply isn't enough. Companies are sitting on long backlogs of AI computing requests. That gap opened the door for a smaller but aggressive player like Nebius to step in and win big business. Nebius is racing to expand its data center footprint. At the end of the last quarter, it had 220 megawatts (MW) of operational capacity, but management is targeting over 1 gigawatt (GW) of contracted capacity by 2026. With Microsoft's billions flowing in, Nebius now has the financing to accelerate construction and bring new facilities online faster. That could significantly boost revenue over the next couple of years. In fact, analysts now forecast that Nebius's top line could increase more than sixfold by 2027. That type of growth explains why investors are excited and willing to pay a premium price for the stock, even though, by traditional valuation measures, Nebius looks expensive today. On the other hand, we have CoreWeave. Unlike Nebius, CoreWeave isn't starting from a small base. This company already pulled in $2.2 billion in revenue during the first half of 2025, representing a 275% jump year over year, and management expects full-year revenue of about $5.25 billion, suggesting growth will accelerate further in the back half of the year. First, capacity. At the end of Q2, CoreWeave had 470 MW of active data center power, already more than double Nebius's current level, and by year's end, it expects to nearly double again to 900 MW. That's 4 times what Nebius has today. On top of that, CoreWeave has lined up 2.2 GW of contracted capacity, a figure that dwarfs Nebius's 1 gigawatt target. Simply put, CoreWeave has more infrastructure, more GPUs, and more ability to serve customer demand at scale. Second, CoreWeave's backlog is enormous. As of the second quarter, it had $30.1 billion worth of booked business, an 86% jump from last year. A big chunk of this comes from OpenAI, but CoreWeave also has deep relationships with other enterprise customers who need GPU power. As new data centers come online, this backlog will gradually convert into actual revenue, giving CoreWeave very strong visibility into future growth. And it doesn't stop there. CoreWeave is also pursuing strategic acquisitions, like its planned takeover of Core Scientific, which will add even more muscle to its infrastructure base. For investors, this means CoreWeave is positioning itself not just as a fast-growing AI cloud provider, but as a company that can dominate capacity at scale in the years ahead. So, which of these companies should you buy? The comparison really comes down to 2 factors: scale versus potential. Nebius is smaller, riskier, and more expensive by valuation metrics, But it has one of the biggest catalysts you could ask for: a deep partnership with Microsoft. If Nebius executes well and ramps up capacity quickly, its revenue could explode over the next 2 to 3 years. Investors with a high-risk tolerance might find this very appealing, especially if Nebius signs more contracts like the one with Microsoft. CoreWeave, meanwhile, already has the scale advantage. It's generating billions in revenue, has more contracted capacity, and holds a massive backlog that practically guarantees growth in the near future. On top of that, CoreWeave trades at a much cheaper price-to-sales ratio compared to Nebius. From a pure valuation standpoint, CoreWeave looks like the safer and more rational choice today. It's important to zoom out and recognize just how big this market opportunity is. The global market for cloud infrastructure services, both infrastructure as a service and platform as a service, is projected to hit nearly $1.2 trillion in annual revenue by 2030. That's a staggering figure, and both Nebius and CoreWeave are fighting to carve out their share of that pie. The truth is, investors don't necessarily have to choose one over the other. Nebius offers asymmetric upside. It could turn into a multi-bagger if it delivers on its Microsoft contract and scales aggressively. CoreWeave, on the other hand, provides a more stable, less risky way to benefit from the AI infrastructure boom. A blended approach could give you exposure to both the high-risk, high-reward potential of Nebius and the steadier, large-scale execution of CoreWeave. Nebius is the ambitious underdog, fueled by a game-changing contract with Microsoft. Its smaller size means more volatility, but also more upside if it executes. CoreWeave is the larger established player with a stronger infrastructure base, a bigger backlog, and a cheaper valuation. It's the safer bet in today's market. So if you're an investor looking for stability and scale, CoreWeave likely deserves the spot in your portfolio. But if you're willing to take on more risk for the chance of potentially higher returns, Nebius might be the moonshot worth considering. Either way, both companies are riding one of the most powerful growth waves of the decade: the demand for AI computing power. And as long as AI adoption keeps accelerating, the opportunities for these two businesses and their shareholders remain enormous. Subscribe to my channel. This is not financial advice.